Welcome you all in at another session of Hedge Fund Accounting. So in this session, we are going to discuss about fund incomes, how fund income team or fund accountants record funds income in the books of fund. So we'll discuss that in details along with few examples so that I'll decode income part. All right. So let's start with the discussion. So if we talk about fund it means fund income it means see to income process means to do the accounting for dividend and that funds received from the the equity, I would say, because funds invest in different equities, and also it's responsibility of fund accountants to ensure that fund accountant is recording that transaction in the books of account on timely manner. All right. Then if I talk about again bond investment, of course, bond investments or loan investments, private credit, or the other obligations or repos which offers interest payment opportunities, and fund is entitled to record interest payment in the books of fund on timely basis. All right. So that's how your accruals and all everything that come into picture. So this is one important head of again NAV package, because income comes under NAV package. All right. If you are working as a fund accountant, then you should know that if there is having any announcement of dividend or interest payment on securities, then of course you can follow that and record in the books of account. All right. As I said, there are two major categories. So we'll decode that. We'll decode first dividend, and then we'll jump on uh, in interest payment part. All right. If I talk about dividend, see, make one thing clear in your mind. Dividend fund accountants record on X date. All right. Dividends fund accountants record on X date. So we should know that. All right. So once the X date announced, then funds consider dividend as accrued dividend from the X date of that security, and few funds consider dividend from the record date also of that particular security. But that depends on the market, whether that market is for X date or dividend, X date or recorded, because there are two categories of market: one which is X date driven market, and another one is record date driven market. All right. In X-day driven market, of course, will consider dividend benefit on the basis of X date only. And if you see any market which is recorded driven market, so it means you can refer or consider record date data or recorded driven transactions. All right. So I hope now you got it. So we are assuming in this particular picture as we are going to refer as a X date driven market. All right. So let's say you have one security, means your fund has invested in Wipro security, and you're holding 100 quantities with price of 350, which is investment price, and dividend rate which has been announced, which is 1.5 INR. All right. So total, if you see rate into quantities, amount would be 150. So 150 becomes your accrued dividend amount. Of course, you should always check the rule whether your fund has securities holding before the X date or not. If not, so it means of course your transaction won't be entitled for a dividend, because dividend rule says we should buy the securities before the X date and hold the securities on exchange or X date. Then only you can record dividend as accrued in the books of account. Otherwise, dividend will receive to the seller. If you see any, let's say, transaction where on X date seller sold the securities and let's say buyer purchased the securities, so in that case, of course, your seller will receive the dividends, and that's what it is important to check whether the fund is holding securities on exchange or X date or not. All right. So here we have taken this. If you see, 1st of Feb was the X date. So second means 1st of January, I believe, was the date which we have taken into this discussion part. So first of January is the entitlement date. It means if you want to get the benefit of dividend, so you should have purchased securities on 1st of January. Then only you can means apply or claim for a dividend. Otherwise you can't. As simple as that. All right. So X date again. So let me just quickly decode means few things around X date and record date. Who announced X date? See, stock exchange announced this date. Okay, then who announced record date? Company announced this date. means company who is announcing dividend, that company will take the responsibility, and company's registrar will announce record date in the market, and company will also process the dividends or any other corporate action benefit as per the record date. Pay date, something which is value date, it means on pay date where company will actually settle the payment in the books of account, and that payment will receive to the end client. All right. So I hope now you got the idea about X date, record date, and entitlement date. Entitlement date also known as trade date as well. So it means in other way around, we'll call it as a trade date, means corporate actions trade date. So before the X date, immediate date would be your entitlement date. So we should purchase the securities on entitlement date to get the benefit of corporate action. So one more thing I would like to tell you now, for Indian market, we have, let's say, your trade settlement cycle which has been changed. All right, and that is affected on now your corporate action exit and recorded cycle. Also for Indian market, we have exit and recorded, means both date are same, but for US and UK market, they still have T+2 settlement cycle. So it means you may see which is X date plus 2 would be your recorded, or recorded minus 2 you can say would be your exit. So basically it's a normal trading cycle. All right, but for Indian market, we have exit and recorded, both are same. All right, so now let come to the main point. If you see, let's say if you have a Geneva system or maybe any accounting system, I have just taken name of Geneva, but maybe you can say different accounting applications with different fund admins. But if I talk about, let's say, accounting system, when you can record dividend as a due or accrue in your books of account, of course on X date you can accrue your income and record the transactions in the books of account. On X date, you can record the transaction receivable account debit to dividend income account credit. All right. So same, receivable that it will receive on value date. Value date, it means payment date. On payment date, you can reverse the receivables. Here we have reverse it out, and cash will, receive. So you can accept the cash payment, which is, see, of course, that payment will be received on bank statement through wire or different, reference number, so that you can refer it and cross verify with Geneva or accounting system. Accounting system versus bank statement, it should tie. If it is tie, then you can post accounting entry, cash account debit to receivable account credit. So sometime, or I would say not sometime, but frequently that you would see where your due amount, it will not tie with the statement. Why? Means you would see, different issues, or I would say, scenarios with this unmatching payment. What if you have due amount which is 150, but you have received only 130? So how will you rectify it? So always I'll quickly just brief about, see if you have any FX transaction. So it means due amount which is set up in USD and received payment which is in, let's assume it, maybe euro or any other different currency. That happened. Maybe let's say another scenario, it can be where the actual dividend rate which is something different. So it means tax rate or a wrong rate which was updated at the time of posting these transactions. That also happened. Maybe bank charges some, apply some charges, or transaction charges applied. So it can be anything. So just you figure it out how you can resolve that. But yes, so you would see different issues along with the dividend part. So we should know it, so that you can cross verify and record it in the books of account. But anyways, if you see any expenses as such, or let's say assume it, you have only received 130 and it is confirmed that taxes applied. Taxes applied. So it's very simple. Cash account debit, which is 130, and rest you can say taxes again. Account debit, which is 20. So 20 debit means 30, which will tie with 150. So this is how you can record transactions in the books of account. All right. So let me take you ahead with X date rule. So this rule is very important, guys. So we apply this rule for entire, different corporate actions. So this rule is basically X date, rule. So we'll have a same rule for a recorded also. Recorded, it means, of course, company will pay dividend as per record date. If you see that rule, so you can say it's a Ex means record date market, but this situation, as I said, we are talking about ex date market. See, it's a cycle. Now, if you see on my PPT, board of directors, they announce, corporate actions. So when they announce, that date becomes your declaration date. So from declaration date to, X minus one, you would see EID, entitlement date. Entitlement date, it means basically trade date. So if you want the benefit of, let's say, this corporate action, so you can purchase securities on X minus one date. So once you purchase it, make sure you're holding that security on X date. If you hold the security on X date, so of course that your name will be reflected in company's books of account, and then company will make a payment to you. So this is how your cycle works. So this cycle which is applies for all different corporate actions, not only dividends. All right, if we talk about declaration date, company issues a statement declaring a specific dividend. If I talk about ex date, first date that is shares trade without and dividend. So ex date also known as expiry of dividend or expiry of corporate action also. So make sure, if you're, let's say, if you're investor or accountant, or maybe any let's say corporate action analyst and all, and if you're looking for, let's say, benefit of corporate action, then you should purchase securities before the exchange. All right. What about record date? All shareholders listed are recorded for receiving dividends. So it means on this date, it will receive, means company will actually, collect the data from the registrar and, sort it out internally, and they'll process payments to each holders as per their company's record. And what about payment date? Payment date, it means company mails or electronically transfer payment to the shareholders. All right, if you have, let's say, a system where, means, client will be notified, or maybe accounting teams will be notified, so on payment it basically MT566 notice, it will be generated, so that you can cross verify it, your bank statement and accounting statement, and record the transaction in the books of account. On declaration date, or maybe on EID or X date, company issues MT564, which contains or provide confirmation of corporate action events, which includes beneficiary name, accounts, payment part, debit, credit, their instructions, additional information, and everything, it will be provided. All right. Then the first date that a share trades without the dividend, if you buy the shares on after this date, it will not receive the dividend. The share price will drop by the amount of dividend paid at the opening of the exchange. So in short, sometime, you would see question around like, does this dividend will affect on NAV? So answer is no, but still I would say we'll have to evaluate. So sometime you would see positive impact, sometime you would see negative impact, or sometime you would see neutral impact, which is different. Because in a technical way, if you ask me, there won't be any impact. The reason is, as I said, dividend amount also, it will, when the company announced, let's say, 10 rupees dividend, so you would see 10 rupees price, which is a drop in the market of that particular stock. That happened. So that's what this will means. This will not impact on companies. Sorry, this will not impact on the funds assets value. But why this happened? Again, your question would be: look, company will process dividends from their balance sheets. So it means that much after the dividend distribution, that much amount, it will be removed from company's balance sheet. So that's what it will be adjusted in the share price. All right. Anyways, I'll take you ahead with other few examples. Okay, so this is my basically portfolio. So if you see, every broker also, if you have in a broker account or custodian account, so they provide. Maybe your question would be like, where we check the corporate action dates and everything. See, every broker maintain data, stock codes, corporate actions, X date, record date, book closure date. See, every broker maintain that information. Every broker carry that information. And if you see here, the broker is carrying all of that information which is needed. X date, record date, right issues, corporate action types, new ratio, old ratio, dividend, rate, or let's say dividend amount for per share. See, this broker is maintaining everything. So same information you can feed into your accounting system, and you can cross verify it. All right. So you can also check the ratio and everything, and accordingly you can update your accounting system. So you can test this with your internal accounting applications also if you have anything. So it was all about dividend part. Now we'll talk about interest payment. See, interest payment, you can carry as accrued income throughout the duration. And once you get the payment, then convert all the accruable into the cash. All right. So this is what we have chart in place. If you see, let's say there are security names, Adani bonds, TCS term loan, then Indian government T-bills or FRN notes, France government notes, the quantities, amount, and everything. So of course, fixed income instrument carries, market rate or maybe floating or fixed rate. So accordingly, you can, carry that interest payments and all. So let's say assume it for a 365 days, 7%, it goes around 7,000. So for a 30 days interest payment would be 58, and for a daily it would be around 1494. So if you have a daily accounting, then you can accrue daily 1.94 interest payment. If you have a 30 days accounting, then you can accrue 58.33 interest payment. And if you have a yearly accrual, then you can do the accounting for 700 on annual basis. So it is depends on your accounting cycle. All right. So here if you see total accrued days means, for example, just we have taken this for example. So let's say here in this case we have accrued for 100 days. So you can record the interest 100 days into daily interest payment. It goes around 194.44. So that you can record it in the books of account. But anyways, as I said, we'll publish the accounting entry for again for aggregated amount. But here we have just taken one example to cover it out. So this 1388.89. So we have accrued interest. We'll update it. In Geneva, you can of course record due amount due to receive from the, let's say, counterparts. And every day means accounting read basically will publish the accounting entry, receive account debit to interest income account credit. So this entry we can post. But once you receive payment, means when cash received or cash settled in your bank account, your accounting looks like. So you will receive transaction type as interest payment on bank statement, and your transaction looks like cash account debit, receivable account debit, and receivable account credit. Why we are going to record this? Because actual due amount was 1300. All right, this one. But how much amount that we have received? Only 694. So it means here the assumption would be maybe for a 50 days only the payment which we have received, and still the amount is remaining, which is 694.44. So that will record it to the debit side of the account. All right. So this is how your accounting works. Sometime you might be see you have received extra payment, you have received, let's say, less payment means overheads or underheads. So depends on the situation, and also that you can go through and check, cross verify, and update it in your books of account. So this, but yeah, so this is how we record the accounting entries in the books of account. So same logic you can follow it while recording the transaction in the books of account. Now your question would be like, so how we calculate, let's say, maybe interest payment. See, we have see always, in most of the organizations, what I have seen, like Bloomberg, that covers this part. Bloomberg compute the interest payment for a day wise. Bloomberg covers everything. So you can shadow your accounting systems with Bloomberg, and you can update it in your accounting system. But how we compute the interest payment? We compute the interest payment like total face amount into 4% interest payment divided by 365 into 363. So 63, it means basically it is for accrued days. If you have accrued days 63, you can compute for 63. So basically with fixed income instruments, ABS, MBS, or all other fixed tranches and all, we compute interest payment through in this formula: face value into coupon rate divided by 360 into accrued days. But in case of dividends, we have a formula: dividends divided by number of common shares outstanding. All right. So if we have this calculation, so amount, it would be around 66.66. So same in both the cases. We have a Bloomberg screenshot. If you see for interest payment also, you can cross verify with Bloomberg. But in this case, amount it will not match because both are, see, this calculation is different formula, and the security is different. So same for dividends also. This was just general rule that we have discussed. But again, on Bloomberg carry that all of the information. Even your normal stock exchange also carry that information. But yes, If you, let's say, if your client allows to follow the Bloomberg, you can follow the Bloomberg. Take the all important details, record date, exit, announcement date, pay date, frequency, amounts, and everything, so that you can, cross verify with the system before posting accounting entries. And even once you receive payment, you can cross verify your payment with all of these details. And also, this is why it is important to cross verify with Bloomberg. All right. So anyways, I'll share this, PPT with you so you can cross verify it. Thank you. Again, so we'll check that few things why income processing is important. So if you see, the goal would be like to ensure incomes from equity and fixed income securities is correctly accrued in the fund for valuation. Otherwise, your valuation may wrong, because income directly influence your net assets value of the fund. Income from equity dividend, run the dividend tracker, check the result in the dividend scrapper or tracker, tie out dividend income expenses to trial balance. All right, answer all dividend related alerts on NAV part. So you can apply all this check in your company also. Income from fixed income, interest income and amortization, run income book, tie out interest income expenses to trial balance, answer all income related alerts on NAV part. So this is what we do with dividends and income. Control procedure, if you ask me, control, it means if you're a team leader, manager, or maybe any other counterparts, so you can cross verify, check to ensure all dividend setup are with appropriate application records, confirm and second sourced by valid sources like stock exchange, Bloomberg, etc. If not, ensure appropriate research is completed and necessary backup is included. All right. Then income from fixed income, interest income and amortization. Check to ensure all fixed income securities are set up with the correct accrual and amortization parameters in application. Check to ensure all variable rates are up to date, and check to ensure all daily changes and income hits are reconciled. So this is what you should check through your control process also. Then additionally, how means your question would be like how your dividends and interest payment looks like in your financial statement. So let me just quickly brief you about first journal entries, which is for interest payment. Interest, if it is due, your accounting entry would be interest receivable account debit to interest income account credit. Same, let's say if interest income payment settled, then your accounting entry would be cash account debit to interest receivable account credit. So if you relate that with the balance sheets, it looks like this portion. So your interest receivable account debit. So we have interest income. Look, we have updated it. So now if I talk about dividend income, so dividend receivable account debit to dividend income account credit. See, income part, of course, you can record it to the P&L. All right, same here also. This portion you can record it to the P&L. Because it's a dual entry accounting system, it means one impact you can update it on balance sheet, so second impact you can update it on P&L. All right. So here also dividend receivable account debit, so it means this dividend you can relate with this one. So we have dividend receivable which is recorded. All right. So same income you can record it to the P&L. So once you received same dividend amount, you can update it under cash book if you have received dividend or anything as such. So you can update your cash book here in both the cases. And then you can remove this. Once you receive cash, then you can remove this one. So you can update your cash book. All right. So this is how we relate that interest and dividend part with your balance sheet also, or same with the NAV calculation as well. Then yeah, this was all about income part. So I need your feedback, like how was the session or what you have understood from all of this. All right, so just let me know, or if you're looking for any detailed sessions, you can reach out to me as well. So yeah, thank you very much for watching this. We'll see you in another session. Thank you.